Hello dear viewers, welcome to my Forex education channel. Today, I'm going to talk about one of the chart patterns that signals trend reversals, the inverse head and shoulders pattern. Just a quick reminder, guys, the information, advice, and opinions you'll find in this video are not investment advice in any way. The content is purely for informational and educational purposes only. We will cover the following topics in order during our content flow. 1. Structure of the pattern. A left shoulder. Head. A right shoulder. A neckline. Height. 2. Trading strategy. Entry. Stop loss. Target. 3. Pattern explanation. 4. Examples on real charts. Now, let's take a closer look at the structure of this pattern. The inverse head and shoulders usually appears at the end of a downtrend, and it's a powerful chart pattern that suggests the price is likely to reverse and head up. The great thing about the inverse head and shoulders pattern is this: it doesn't just show us where the reversal points are, it also lets us see how vibrant and eager the current trend is. When we look at each part, the head and the shoulders, together, we can see much better why this pattern gives such a reliable signal. Let's start with the first step in the formation of the inverse head and shoulders pattern, the left shoulder. While the downtrend continues, the price slides downward at some point and forms a bottom there. After hitting this low, the price slightly recovers, moving upward. This move gives us a feeling that the sellers aren't as strong as they were, and buyers are slowly starting to appear. Even though it might not look like a huge change on the chart, it's actually one of the most important parts because it marks the very beginning of the formation. It's here that we notice the downtrend slowing down for the first time and the market taking a breath. Once this structure is complete, we end up with the left shoulder, which is the first shoulder of the inverse head and shoulders pattern. After the left shoulder is formed, we see the head, which is the most prominent and noticeable part of the pattern. At this stage, the price drops down again, but this time, it forms a bottom that is deeper than the left shoulder. When you look at the chart, this movement might look a bit aggressive because the price moves below the previous low and creates the lowest point of the entire formation. While this visual might make you think the sellers have taken one last strong step, this move actually constitutes the most critical part of the pattern. Following this deep low, the price starts to recover upwards. This recovery feels more noticeable than the rise on the left shoulder, because while the price moves upward after leaving the lowest level behind, a sense of reversal slowly begins to appear on the chart. The rise that forms here is an important sign that the market now wants to move away from the painful downtrend. The most characteristic aspect of the head part is that the declines have now reached their peak. In other words, the lowest point on the chart is here, and as the price moves up again after touching this level, we see a stronger version of that first recovery we saw at the left shoulder. This helps us understand that the downward steps of the market are weakening and the desire to move upward is now becoming more clear. When the price moves up from the head section and proceeds toward the neckline, the central structure of the pattern is completed. This section is considered the heart of the inverse head and shoulders pattern, because both the deepest bottom and the place where the reversal is most clearly understood are exactly here. After the head part is completed, the last step of the pattern, the right shoulder, begins to form. This section is often the part where the reversal becomes clearly visible. After the recovery in the head section, the price pulls back a little, but this decline is now much lighter compared to the previous lows. In other words, even though sellers try to show themselves again in the market, their impact has clearly weakened. It is very important to see that the price does not approach the bottom level of the head section during the pullback of the right shoulder, because this shows that the downward direction in the market is losing ground and buyers are starting to appear more decisively. In short, the small drop that forms during the right shoulder is the final link that completes the structure of the pattern. While watching this section, the noticeable thing on the chart is that the price can now recover more comfortably. The recovery at the left shoulder was lighter, the recovery at the head was wider, and at the right shoulder, we can clearly feel that the price is now starting to show its direction. Since the pullback does not deepen too much, the movement looks more consistent when the price turns upward. When the right shoulder is complete, the price moves upward again and approaches the neckline. At this point, the entire structure of the pattern becomes clearly visible. The role of the right shoulder is to complete the reversal story and give the final signal that the price is now ready to draw a new path. This is why when you look at the chart, the combination of the left shoulder, head, and right shoulder makes the idea of a reversal most clear. In the inverse head and shoulders pattern, the neckline is the line that connects the peaks of the left shoulder and the right shoulder. This line is the most important point for understanding that the structure is complete. The neckline can be flat, upward sloping, or downward sloping. What matters is that the price breaks this line upwards. When the breakout occurs, the pattern is confirmed, and the upward movement usually continues more strongly. In the inverse head and shoulders pattern, a flat neckline is the horizontal line that appears when we connect the peaks of the left shoulder and the right shoulder. This means the high point of the left shoulder and the high point of the right shoulder are at roughly the same level. This type of neckline is the clearest and easiest to observe for an upward breakout. If the price passes this horizontal line after the right shoulder, the pattern is confirmed, and the upward movement usually progresses more smoothly and quickly. Flat necklines are the type most easily followed by traders and most often used as trading signals. Sometimes, the neckline in an inverse head and shoulders pattern isn't flat. It can be sloping either up or down. Upward sloping neckline occurs when the peak of the right shoulder is slightly higher than the peak of the left shoulder. In this case, the price has to move a little more upward to break the neckline. This type usually gives a stronger bullish signal because the price needs to gain upward momentum. Downward sloping neckline occurs when the peak of the right shoulder is slightly lower than the peak of the left shoulder. In this case, the price can move more easily while breaking the neckline, but it may face some difficulties before the breakout. The important thing is that, regardless of the slope of the neckline, the price must move above this line. When this breakout happens, the pattern is confirmed, and a strong upward movement usually begins. Friends, one of the most frequently asked questions about the inverse head and shoulders pattern is undoubtedly the concept of the pattern height. So, what exactly is this height, and how is it determined? The pattern height usually refers to the distance between the head's lowest point and the neckline, and it plays a crucial role in calculating price targets. This means measuring this height correctly helps us understand how far the price may move after completing the pattern. Additionally, this height helps traders make more reliable decisions regarding risk and targets, making the inverse head and shoulders pattern a more dependable tool. Now we will start talking about how to use the pattern and our trading strategy. More precisely, we will find answers to questions like what we can do after the price breaks the neckline and which steps we should follow. Here, the important thing is not just to see the pattern on the chart, but also to be able to use it within a plan and a system. We have observed the inverse head and shoulders pattern and set our target. So, as traders, at which point will we enter a position, how will we limit our risk, and at what level will we take our profit? This is exactly where the key components of a trading strategy, entry, stop loss, and target, come into play. Understanding and applying these correctly turns the pattern from just a chart formation into an active trading tool. The first step in our trading strategy is to determine when we will enter a position. In the inverse head and shoulders pattern, the first entry point is the moment the price breaks the neckline upwards. This entry is preferred when a strong breakout occurs. This breakout shows that the pattern is confirmed and actually indicates that buyers have started to take control in the market. Entering a position after the neckline is broken shows us that the downtrend has ended and an upward movement has begun. Therefore, the entry point is a critical step that allows us to actively include the pattern in our trading plan. The safest entry method is the pullback, meaning the price returns to test the broken neckline. The price first breaks the neckline upwards, then approaches or slightly touches this line for a while before starting to rise again. This retest shows us that the inverse head and shoulders pattern is solid and that the upward movement will continue. Entering a position from this point can sometimes be safer than entering directly at the breakout, because the price retesting the broken level confirms that buyers in the market are determined. Keeping our risk under control is always the most important and primary step in trades based on the inverse head and shoulders pattern. The stop-loss order in a trading strategy is a vital tool that protects us against false breakouts and unexpected price movements in the market. There are two main approaches for placing a stop loss in the inverse head and shoulders pattern. Traditionally, the stop loss is usually placed just below the breakout point where the pattern is confirmed. However, to avoid high volatility in the market and provide a wider movement range, the stop loss can sometimes be placed near a level just below the lowest point of the right shoulder. This way, if the price moves against the direction we expect, our capital is protected from huge loss. This approach makes our strategy safer, more sustainable, and disciplined. When trading based on the inverse head and shoulders pattern, the next priority step is determining our take-profit point. When most of us spot this formation on the chart, we immediately think, okay, but how far is the price going to go from here? This is where the target comes in. The target is essentially a measurement that shows us the approximate level the price can rise to after the pattern is completed. Determining this isn't very complicated. The only thing we need to do is measure the distance between the head's low point and the neckline. So, what's the difference between the pattern's deepest point and that critical line connecting the shoulders? We can expect the price to move upward by at least this difference. Once we've made this measurement, we can actually act with a bit more confidence in the market. The target doesn't just allow us to estimate how high the price might go, it also helps us plan where to enter and where to exit when opening a position. So, instead of just looking at the chart and guessing, we can execute our strategy in a much more controlled way. As we determined earlier, the pattern's target is calculated by projecting the distance between the head's low point and the neckline upwards from the breakout point. When the price reaches this level, we can close our position or update our strategy for new opportunities. The target helps us both lock in our profit and make our trading strategy more systematic. Inverse head and shoulders is a chart pattern that signals a change in direction in the market. After a long bearish trend, when this pattern forms, we actually see that sellers have started to lose control. The market pauses at some point, and buyers become more active. When the pattern is completed, the price begins to rise, and the downtrend becomes ready to be replaced by an uptrend. The important thing here is that the signal given by the pattern indicates a trend reversal. The bears are no longer as active as before, and the bulls are beginning to lead the movement. Inverse head and shoulders acts as a kind of guide for traders. As the price starts to change direction, we can notice that an upward movement is beginning in the market. This allows traders to observe the start of a new trend and adjust their positions accordingly. In short, the inverse head and shoulders pattern is a clear sign that the bearish trend is ending and the bullish trend is taking over. When followed correctly, it is very useful for understanding trend changes and taking advantage of opportunities. Guys, let's look at the real part of this, which is the charts. Here is a classic inverse head and shoulders example with a flat neckline. As you can see, the price first made a drop and then recovered. Then it went down to a deeper bottom, head, which is the lowest point of our pattern. After that, it made another recovery and formed a higher low, above the head and close to the left shoulder level. Look, the neckline, which is the line connecting the peaks of the shoulders, looks almost like a straight line. This is the cleanest and easiest to read form of the pattern. What's the key point? The moment the price breaks this flat neckline upward, it suddenly surged with strong volume and gave a buy signal. This is the clearest sign that the downtrend has ended and the direction has now turned upward. Now let's move on to a slightly more complex situation. The neckline is not always flat, right? Here is an example with a down-sloping neckline. This chart is whispering the following to us. Sellers continued to stay dominant, but at the same time, buyers slowly started to gain strength. After the left shoulder, the head formed. Then, while the right shoulder was forming, its peak stayed lower than the peak of the left shoulder. When we connect these peaks, the neckline appears slightly slanted downward. So what does this mean? Technically, this pattern gives one of the strongest reversal signals. Why? Because for the price to break out, it's not enough to just pass above the neckline. Buyers also need to overcome this downward sloping pressure. When the breakout comes and the price moves above the neckline, it usually continues with a strong upward move. As you can see, that's exactly what happened here. Our other example is the most liked one, the upsloping neckline. This is a pattern that shows how eager the market is to recover. Just like in the others, the shoulder-head-shoulder structure has formed, but pay attention. There is a difference between the first recovery peak formed after the left shoulder and the second recovery peak formed after the head. The second peak is formed higher than the first one. When we connect these peaks, the neckline appears slightly slanted upward. This actually shows that even before the downtrend ends, buyers are pulling the price upward more eagerly from each dip. This is a signal that the trend is very close to reversing. But you need to pay close attention to one thing here. When a breakout occurs on this type of neckline, pullbacks, retests, can sometimes happen more frequently. But the main rule remains the same. The neckline is broken, the volume supports it, and the setup is complete. The trend has now reversed. Friends, we've identified the pattern and understood how strong it is. So what do we do now? When do we buy, where do we place our stop, and where do we take profit? These three questions form the foundation of a successful trading plan. Our entry is very clear when the neckline breaks to the upside. Look at the chart. The moment the price pushes through this resistance line, the neckline, with a strong candle and solid volume, that becomes our entry point. Tip: if you want to be a bit more cautious, you can wait for the price to pull back to the neckline after the breakout and test it as support, a retest. This gives you a second strong confirmation that the pattern is valid. Risk management is everything. So we must set our stop loss without question. The most reasonable stop loss level is slightly below the breakout point, just like in the chart you're watching. But the safest place is at the most recent and final low of the pattern, which is the lowest point of the right shoulder. If the price drops below this level again, it means the pattern has failed and the trend has not reversed yet. In that case, we exit the trade with a small loss to protect our capital. Remember, the head is the lowest point of the entire structure, and breaking below the right shoulder destroys the pattern. Now let's move to the most exciting part, how to find the target price. The measurement is very simple. First, measure the vertical distance between the head and the neckline. This gives us the pattern height. Then take that same distance and project it upward from the point where the price breaks the neckline. This vertical measurement gives us the minimum expected target price. Once the price reaches this level, we can lock in our profit. Guys, let's wrap it up. When we look at this chart, we're actually seeing the core of the inverse head and shoulders pattern, trend reversal. The end of the bearish trend. Before the pattern began forming, the price kept making lower lows and lower highs. This is the classic bearish trend, a period where sellers dominate the market. But once the head formed and the right shoulder created a higher low compared to the head, that moment started whispering something to us. The bears are getting tired. The selling pressure is fading. This sharp downtrend is about to end. And then the moment arrives. The price breaks above the neckline with strong volume. This breakout is not just the price passing a technical level. It is the official announcement that the trend has changed. Now the chart is telling us a new bullish trend has begun. The price starts forming higher lows and higher highs. The inverse head and shoulders pattern gives us the ability to recognize this major reversal early, manage our risk properly, and most importantly, catch the upward movement right from the beginning. That's exactly why this pattern is one of the strongest reversal formations every trader and technical analyst should know. Dear future traders, years of experience makes one thing very clear. Risk is unavoidable in Forex and financial markets. Even the most solid strategies, including the inverse head and shoulders pattern, can sometimes fail. Because of this, you must always have a Plan B, which is your stop-loss level. Remember, we are not chasing certainty here. We are trying to catch scenarios with a high chance of working out. But here's the good news. The inverse head and shoulders is one of the strongest signals in the market. If you read this pattern the right way, you can see not only that the downtrend is ending, but also gain the chance to join a new upward move from the very beginning, with your risk kept under control. Do your analysis, set your risk, and most importantly, follow your rules. With the right mindset and patience, it's up to you to make use of the opportunities the market offers. Dear viewers, if you got stuck anywhere or have any questions, feel free to mention them in the comments. Also, don't forget to like the video and subscribe to the channel. See you in the next video. Take care.